We're at the end of our presentations. Joe's going to be framing it for us, and really appreciate Joe taking the time presenting live here to us out of his home here in Vancouver. And I'm going to stop sharing my screen so that.
Yeah, well, thanks for having me, Kai. I'm going to keep the rhythm going with respect to timing, yeah, this is the first one for Soar, so I'm happy to do this and happy to present to a lot of the European audience, as a lot of our subscribers are European, so we appreciate the opportunity of getting out to that market. So this presentation is not about gold and that. It's about, if you've accepted the thematic, now you're investing in the junior mining sector, you know, what are some of the risks that we look at exploration sites, and some that you could sort of look at as well. You know, as we know, like there's over 900 mining related companies listed on the TSX Venture, which is about half of the total companies listed. And there's another 206 on the main board, but they don't take as much bandwidth on the main board. It's only 13%. So these mining companies up to the end of May raised about 1.8 billion Canadian in about 500 different transactions. So these transactions continued into June and continue right now into July, as far as I can see with the news releases. And so for any individual investor, whether buying on in the market or going through these private placements, there's a plethora of opportunities out there. And the important thing that I try to do is try to get to know quickly, so that we're not doing a deep dive on every one of these 900 companies. And so this is a modified version of the Lafond Curve, you know, and as you can see, going from left to right, we're going from grassroots exploration, where, you know, there's no technical reports really of any merit. The market caps, you know, well, it used to be less than 10 or 5. Now it can be 20 to 40, and some of them are 100. Run usually by geologists. This is really the lottery ticket, the high risk, high reward, the triple bagger or even higher. So as we transition, you know, the discovery in the grassroots stage is really what adds value. It's less about the commodity price, it's more commodity agnostic. It's more about actually getting drill results. Once you actually do find something, and then you get into the development stage, all those studies take away, let's say, curb the enthusiasm of the initial grassroots exploration discovery. And then you get the engineers, the development people that start looking at it from all the risks. And so a lot of the risks I'm going to talk about today, we'll try to apply those sort of lenses early in on the program. And so your opportunity in this sector is to start, is to invest in the grassroots, the high risk reward, the development play where the value is taking it into production, less news flow, engineers running the project, financing becomes a huge risk as well, because you're actually looking for the capital development project. And then lastly, you can invest in the actual producer, whether it's junior or major, more liquidity, less upside potentially, more leverage to the gold price. And so in anything, diversification is important, whether it's by you know, sector, but also here, as you can see, by stage as well. And so what I'm going to look at is some of the risks involved in investing in any kind of mining company. You know, we can talk about, I mean, this list is not exhaustive, but I mean, resource risk, mining risk, processing risk, the execution risk, geopolitical, financing. So all of these risks have various components related to it. And all of these risks can have a fatal flaw that can prevent the company from actually ever developing the asset, or prevent someone from actually making an MA bid on the project. So if you can understand those early, then in terms of your filtering, you can avoid those companies early and focus on the ones that have none of these fatal flaws. And so a lot of the projects, their issues, are related to the underlying geology, about the grade continuity. And we've seen a lot of projects basically die on the vine because of that. So let's go into a bit detail about that. And so, what all these companies do is try to drill to test their hypothesis. And so to test the subsurface geology, drilling can actually take many forms. There's, there's a lot of different methods, but I just talked about three. Like I used to do a lot of rotary air blast or RAB drilling in Australia. And because we had cover, we would drill to bedrock. Wouldn't give you a lot of geology, give you a bit of alteration, and give you a geochem. That's what you would get. And then from there, you would generate targets, and then you would come back with what we call reverse circulation. And so all we're doing is basically pulverizing the rock, making chips, getting geology and alteration, no structure, but also obviously geochem. Better than rotary air blast, but not as good as diamond core. And so when we get into the diamond stage, now we're talking about continuous rock. We can see not only alteration, geology, we can see how the veins are oriented. We can obviously get geochem as well. But we got to realize is the diameter of these drill holes are like the diameter of a wine bottle, and if you're testing, drilling 25 meters, which, is pretty common, they would represent next to 0.001%, a very small fraction of the total volume of rock you're inferring is that geology, that mineralization, that alteration, and potentially that grade. The important thing is the more predictable the geology, the more continuous the mineralization, and then the better the resource estimate. And we got to remember that a resource is an estimate. We're taking all that data and saying, okay, I'm inferring this kind of resource. If I do more drilling, I'm indicating this kind of resource. And if I really get down to mining it, then I want to measure at least the first few years of resource. And those are the different categories that we drill for. But most of the junior companies, some of them don't even have a resource, but really their thinking is to get at least to inferred, because as we know, scoping studies on the TSX can be done on inferred resources. So this is what core looks like. And you see on the left-hand side, you see what are low sulfidation epithermal veins. You see the white in the middle boxes, those are veins, and you got some breccias at the top, and that's basically what you're looking at. You look at it from top down, and you look at it from left to right, like reading a book. On the right-hand side, what you see is some massive nickel mineralization here in the center. And then on the right hand, what we would call net textured nickel mineralization. The left hand side is low sulfidation epithermal mineralization from Japan by Irving. The right hand side are nickel holes drilled by Blackstone Minerals listed in Australia in northern Vietnam. And so here are the issues. Okay, so imagine on the top side, you're drilling holes, let's say every 50 meters, vertical holes, and you get an intersection in hole 1, you get an intersection in hole 2, seems to peter out in hole 3, and then you see it again in hole 4. So you're thinking maybe something's happening between holes 3 and 4, and the mineralization sort of dying into it. And you're assuming that it's subvertical, and maybe it's because you did RC and reverse circulation, and you don't really understand the structure, and you're inferring, or not even inferring, what you could have. And so if you did a resource in that, you would look at it like a tabular body, and draw this tabular nature to it between the holes, and potentially say, well, there is no waste there. This thing continues because I've drilled it here and I've drilled it there. And so when we start looking at it in more detail, and maybe we've got diamond holes, and now we can see structure, we can see the orientation of the structure suggests that the mineralization is not flat, that it's very steeply dipping. and the intersections are true with giving us a true thickness of mineralization, but they're apparent, such that they might be 50% or less of the thickness that we're looking at in the downhole results. And so also the continuity becomes a question. So if I started drilling in between hole 1 and hole 2, I might not see anything, maybe 15 meters away from hole 1. And we can explain that with the bottom figure. But that's where the top figure would actually stop making sense. Okay, so these are risks that we have to deal with. And when we deal with holes that are not core, widely spaced, we don't know everything, and hence the word inferred. So here we see an actual example. This is by a big company. This was several years ago with the Eleanor mine, the Gold Corp purchase. Now it's Newmont. But basically, you see the blue dashed envelope, and the blue dashed envelope, based on these three holes, was assumed to be the resource envelope. So everything within that blue was mineralization. So you can see, wow, that's got a lot of tonnage implications. But they drilled down. The real true thickness, closest to true thickness, would have been the first hole to the left. The second hole drilled down.
So actually shows that what was going on, like since the start of the just composite all this and it looks like it's similar to a movie show.
Joe, you have to mute or unmute your microphone again. You crackled a lot, and all of a sudden the sound just went completely robot. See if that changes anything. Can you say something? Now? Oh, fantastic. Thank you.
Yeah. Okay, good. Okay, sorry about that. I don't know how long I was down. But what's happening is that they didn't recognize that there was dead zones in that hole, on that last hole. And if they had the proper diamond drilling, they would have potentially seen how the structures are changing down hole and maybe mapped that limb of that full bending. More drilling proved it out, but then we realized a big reduction and a downgrade in the resource. Okay, a recent example would be Guyana Goldfields. Guyana Goldfields has the Aurora gold mine in Guyana. And so they developed this project, gold in veins, greenstone belt sort of stuff. So they were trading at one point in the middle of July, in the middle of 2018 in July at about $5. And as they moved to the right, we saw that the resource wasn't really holding up. They updated the life of mine plan, and they had these proxy wars. But really what happened was they had a 40% plus drop in the reserves because of a lack of geological continuity in the gold mineralization. And that not only, most of it was a drop in tonnage, but what was left was still lower grade. So the new plan was more underground, less open pit, but now we're still only mining less than 3 grams, which is not great for underground, and it's not much different than the open pit. Again, several changes in management, proxy fights, and it got down to a low of, well below 50 cents. But if you got it then, we had a triple bid on it between 3 different companies, and eventually Zijin Mining put in an all-cash offer for $323 million. Distressed asset by all means, but the distressed nature of the asset was driven by the lack of geological continuity of the gold mineralization. So if we look at one that I own and I like, and I picked up in mid-March, Bellevue Gold in Australia, and what I like about it was the continuity and the high grade. So it's great to have a high grade, but when it's continuous, it's fantastic. And so they had an inferred resource of 2.2 million ounces, grading about 11 grams. The updated resource was all about converting some of that inferred resource from the surface, as you can see all the drill holes there, the drill rigs up there on the top diagram, into the indicated category by infilling them from 80 meters to 40 meters. And even 40 meters is pretty wide for a gold deposit, but it works for this one because the gold variability is rather low. So right now they've got an indicated resource about 900,000 ounces of over 11 grams, but they still have inferred that they're going to start drilling out once they drain out the underground workings from the previous operator, because it's much cheaper to drill a lot of these holes from underground. So that's, now we move on to another significant risk is like, how do you mine it? You know, what are the costs? You know, what's the dilution? What's the strip ratio if it's an open pit? So let's take a look at that. So open pit mining, extraction from the surface, you generate waste rock, and that's basically when you set a cutoff grade because of how much it costs you to mine, how much it costs your process, your recovery in that, you work out, okay, below this grade is waste. Okay, but note, in an open pit, and somewhat in underground, some of this waste needs to be mined regardless. So you're going to pay for it anyway. And it doesn't cost much different. The only thing you're not doing with waste is basically processing it. You're still mining it and putting it somewhere. Underground mining, you know, can be anywhere from bulk tonnage, and we'll talk about this with block caving. It's basically an underground open pit. You can get moderate tonnage, you know, which would be higher cost than a block cave, but still decent throughput, you know, with sub-level stoping or something like that, or small tonnage where you're dealing with a small vein that might be less than a meter. You bulk it out to maybe 1.5 meters, and you do something like cut and fill mining because you don't want to take a lot of the waste rock. So if you look in the Newcrest slide here about the differences in their own operations, from open pit mining to the left, to selective underground in the middle, all the way to block caving on the right. So you can see that open pit mining is done at Lafond and Telfa, but you can see Telfa not only has open pit mining, it's got selective underground because of the nature of the mineralization, but also in some areas the mineralization blows out enough and is disseminated enough for to do more bulk underground sublevel caving. So you can get a whole bunch of different methods. Importantly for them, their flagship Cadia is a low-grade big deposit that we'll talk about, but it can be block cave mined, hence that lowers the operating cost significantly and increases their margin. So let's just look at the open pit scenario. And so let's assume a cost of about $3 per ton. So we're converting now, that's mined $3 a ton. But when we process, we only process ore, we don't process waste. So when we want to convert this to milling, we not only have to include the cost of the ton of ore, we have to include the cost of the ton of waste. Okay, so if we look at two open pits, one is a thin ore body, and one is a thick ore body. And let's assume it's something in West Africa or Western Australia, where we have an oxidized layer on the top, and then we get straight into the sulfide, which is more of the orangey area. So the blue would be the oxide. And so when you get into the first open pit, you want to take the oxide out. It's softer, it'll run faster, and the strip ratios are about the same, 1.7, 1.8. The first shallow open pit on the narrow structure would be about $8.40, whereas the one on the right would be about $8.10. So not much of a difference. But when we get to the next phase of the open pit, you know, where we're taking on more waste, the second phase, the strip ratio blows out to about 4.4 to 1. So we're mining 5.4 tons, you know, of material there, you know. So when we look at that cost per process ton is about $16.20. Whereas on the other side, because the mineralization is thicker, subvertical here, it would cost about $9. And so that has a significant implication on the economics of deposits. So that's something you want to watch as well. And on the other side, you've got to look at it from the point of view, when does the strip ratio get so excessive that it's time to go underground? And that happens a lot. I mean, when I worked at this gold mine in Queensland, in Australia, we had an open pit. The strip ratio started getting excessive. It was very high grade, but then we went underground on it. Okay, so block caving is something you'll hear a lot about with really big deposits, and most of these are porphyry deposits. And porphyries can be very big, disseminated deposits, and that it runs well with these block cavings, because block caving is not discerning about grade, or it's not selective at all. So it'll just take everything. And so the beauty of it is that you get a very high throughput, and the cost of mining it is not dissimilar to open pit mining. It's basically an upside down open pit. The issue with it is it's not for everybody, and it's not for every geological deposit. And also the upfront capital can be very large, because you have to go almost right down to the bottom of the ore deposit with respect to development. So, but on an operating sense, it allows lower grade deposits to be mined profitably, like Cadia. Newcrest is a master of this mining technique. You've got almost 3 billion tons of material there, grading about 0.36 grams per ton gold and about 0.26% copper. Not something everybody would mine selectively, but bulk tonnage underground, it works, and it's made them a lot of money. Something that didn't work was for Rio Tinto, diversified miner. They're not only looking at block caving underground at their Oyu Tolgoi project in Mongolia, they're also looking at doing something similar at Superior, Arizona, with the Resolution mine. And so this underground block cave, they did a study, they revised it with a more updated feasibility study. The drilling, the geotechnical drilling, just proved out a lot of instability. And so they had to redesign the block cave, and resulted in a 50% cut in reserves, and also a delay in the development and an increase in capital. So block caving is good, but it's not for every deposit. And so I take you to a resource that just came out recently, GT Gold. And GT Gold is a company that made a fantastic discovery up in Golden Triangle, really close to a deposit called Red Chris, which is a gold-rich porphyry system that Newcrest bought 70% of for about $800 million in 2019. So it's a great address. They had some great drill hole results. Now they're establishing a resource. So their idea here was trying to establish a resource with standalone tonnage. And so if we look at tonnage of Red Chris between the open pit and underground, it's over 1 billion. If we look at Galore Creek, another gold-rich porphyry system that's Teck and Newmont, that's about 1.1 billion tons. And so that's about the range. And so this South North prospect of GT Gold, they wanted to put out a big number, and they did. About 840 million tons. When I looked at it, and this was based on the drilling to the end of 18, I thought of a lower tonnage, higher grade potential that could be an add-on to Red Chris. And so what needs to happen for it to be taken into Red Chris, it has to be exceptional and has to be better than what they have. And so right now they're trying to push a standalone, but the standalone right now has a copper grade that's about 25% less than Red Chris. So the question is this thing economic right now? And so the expectations for grade from the market were probably a lot higher, and hence GT shares fell about 25% on 10 times the volume yesterday. Okay. So these are the models. The model on the right was my initial model at the beginning of 2019 based on everything in 18. And so you can see a transition from open pit at the top about 200 to 250 meters of open pit that I modeled, had a cutoff grade of 0.25% copper equivalent. I increased the cutoff grade as I went to depth for underground and took it down. The vertical relief on that's about a kilometer. What they're proposing right now with their resource is about 1.8 kilometers of vertical. There's an open pit component, but I'm not sure really where the cutoff is. Their drilling has got an indicated core and a halo inferred. The issue is, how do you mine it? And with bulk tonnage mining, can you actually take it all the way to the bottom? I don't know. That'd be a lot of underground development to get there. So again, I was going for something that could incrementally add on to Red Chris and be better than what they had. They're approaching it more as a standalone, potentially because their partner is Newmont there. But right now, the grade might not be there. And so more drilling may be required. Okay, so this was just a taste of some of the risks, the technical risks involved in investing in the mining sector. I wanted to go into detail into a few as opposed to giving you like the 50,000 foot thing on everything. There are more risks. Processing is a big one. Is it refractory? Is it free milling? What's the grind size? Do I need more power? Execution, social license to operate is a big deal everywhere, even more so now with COVID. The permitting risk, infrastructure, talk about water in places like Chile, power in places like West Africa, geopolitical, creeping nationalism, increases in taxes, royalties we're seeing, security risks. And then when you're doing the development and exploration, do you have enough money? Right now, the market for precious metals is really good. So financing risk right now has abated, but those other risks are really still there, and it's really up to us to do our due diligence to find them. So what we try to do is take these risks and try to understand them and present them to our subscribers about why we think this is a good buy or why we think that this might not be a good buy or why we're selling the company. So that's it for me. Thank you very much.